Well, it really does feel like a Friday. I suppose that's a good thing. Spot Gamma is running a little late, so I don't have an AM founder's note, but I did share the PM version, which I gotta say, usually has really good insight on what happened on the day, and then they do a lot of looking around, upcoming earnings and just kind of talking about what's on their mind. So even though it's not the AM one, take a look at it anyways. And when they do put the AM version in there, I will share it out. All right, so the biggest thing on the table today are the revised CPI numbers. This is kind of a big deal. The last time we got it, it was a shock to the system. So we want to be prepared for that. We're going to get the normal CPI numbers next week. I believe it's going to be on the 13th. It'll be Tuesday. So other than that, I mean, we got a Fed speaker today, someone out chipping their teeth that maybe doesn't feel like they had their fair share of the media attention. And that'll wrap us into the weekend. Hong Kong is basically flat on the morning, the UK right behind them, and Japan up the most, more than 0.5%. But right behind them, man, the small caps, like they got left out. They wanted to participate in this runaway market. So behind the Russell, we have the Nasdaq more than 0.25%, S&P under that 0.25%, and the Dow basically flat with Europe. TGIF, yes, yes. So 1:30, Lori Logan is going to speak. 8:30 is the seasonal factor revisions of CPI. Yeah, it's kind of a mouthful. This is one of those mornings where we could get a liquidity gap. So, just kind of keep that in mind. It's worth, being aware of. I do like that liquidity gap trade when we get it. It's kind of looking like a boring Friday, and we're going to get these numbers, but then what? Everybody's been looking for that blow off top move. And yesterday I was going through some market breadth and just kind of looking around. Everything that I got says it's still going. We're extended. Yes. We're, way extended on some metrics. And yet it's not giving any sort of topping patterns or any sort of blow off top signals. Probably helps to put that on the right screen. All right, so as you can see, it's really short, and the CPI revisions doesn't even land in the Thinkorswim calendar for the day. I think this is going to catch a number of people off guard, and if you doubt how significant it can be, they're hedging this morning. They are not going to spend money to buy insurance unless they feel that there's a reason to, right? Because remember, hedging is cost. Hedging isn't a trade that you're looking to make money on. I know that we've done those kind of trades with options just, because we could. But most of the time when you put a hedge on, it's not a trade to make money. Let's put it into an analogy that makes sense. You don't buy house insurance for fire, hoping that your house burns down so you can collect the money and then consider it a reward or profit, right? So that's the best analogy for a hedge. It's house fire insurance. And the only way you're going to collect that insurance is if the house burns down. You kind of don't want the insurance, right? You'd rather keep your house. They did not roll up the call wall. It's still 50-20. And now we're above it. So we got into it yesterday in the afternoon, right before the close, and the liquidity still was there, and it just sold right back out of it. It was kind of violent, went right back to VWAP and then right back up again. But we are through it this morning. Really kind of got a feeling that they're not looking to move that yet. The SPX call wall was at 5,000. It's kind of buried under some labels here, but I'm pretty sure, yeah, there it is. It's still at 5,000. That's bearish. The fact that they didn't roll it out is bearish. And the put wall is still at 45.20. So on those market breadth things that I was talking about that had not given a blow off top signal, those aren't the S&P. The S&P right now is showing a continuation after a pause. There's two ways to look at this continuation. It's a little bit of a last hurrah before we turn and dump, or after lagging momentarily, we're now going to continue to the upside. If you try to go back into the past and find examples where we had a really big day and then a pause day, the pause usually lasted for a few days before we continued on. Here's another one where we had a nice big move and a pause, and then we continued on. The concern is that we're going to get something that looks a lot like that. So we had a really big move, and then we paused, and then we rolled back down again. Now, on the year, I don't think we're going to revisit the year-to-date VWAP. I don't think that's in the cards. But that doesn't mean that we can't pull back some. And if you look at this blue line here, either one of those, it's the 10-period moving average. The reason you see two of them is because the question, should we use the EMA or should we use the SMA? I say put both of them on there and quit worrying about it. Over the years, I've kind of come to the conclusion that most of the time it really doesn't matter. But if you can't convince yourself of that, you're going to constantly wonder, should I be using the EMA or the SMA? Gosh, Joey's using the SMA, but Sarah's using the EMA, and I don't know. Sleep well at night. Put them both on. At some point, you'll convince yourself that it really doesn't matter, or you'll start to really like one versus the other, and you will get over that argument. Either way, you can see that we're a bit extended from the 10, and we're going to go look at the measures. I'll be able to tell you exactly how far from the 10 we are. The point is the 10 often is the mean. It's the average. Price doesn't like to get too far from the average. So when it does, we tend to consolidate or pause and let that 10 catch up with us before we make another leg. And then we get overextended. We tend to pause, consolidate, and we let that 10 catch up to us again. If we don't have the patience to let it catch up with us, then we turn around and we go back into it just to kind of speed things along. And then we continue our move to the upside. So we haven't had a retest of that 10 now for a little bit. It's been a while. And at this point, the question becomes, are we ready? Are we due one? There's a 5-bar rule out there that kind of works. But like anything, it's not a perfect science. And does the 5-bar rule have anything to do with this? Well, the 5-bar rule is generally color. So it would be, 5 bars of green and then you expect a red, or 5 bars of red and then you expect a green. What we're more talking about is, when was the last time we tagged that 10? And what's the average count before we do tag the 10? It's kind of an interesting question because I'm a little bit of a nerd. And I'm probably going to try to figure out how to calculate that to where the machine will just give me the answer. Because what we're trying to decide here is, have we gone too far, too fast? And does it owe us a pullback? On this grand scheme of things, if you look at it on a weekly, I mean, that, you got to admit, that just looks absolutely phenomenal, from 4,100 to almost 5,100. That's extravagant. All of the tools out there say we're not getting a blow off top. Price shows that we're not giving a topping pattern. We want to measure last week's range and kind of get some levels out of it. One of the levels that we're looking for is a measured move of 50%. It's 50, but that would be at 50.63. It's a long ways off. A number that is much closer to us is 50.28. So we're going to keep those two, 50.28 and 50.12. 50.11 is a cog line and 50.32 is a cog line. It's kind of close to cogs on either side. We're at 50.26, so we're really close to that 50.28. And really, if you look at the ticks, it's closer to 50.29, which gets us closer to 50.32, which is the cog line. But that measurement was for a weekly, and we've had this sideways day yesterday. So we want to do the same thing again. There's our 50% measure, and that is 50.28 and a lot closer to it. So we can take off the 1, 2, 3, 6 measure now. We can just go ahead and get rid of that. And we'll keep that 50.28 as a 50% measured move of the candle of yesterday. They're sitting out. We can see the very low volume. They are sitting out waiting on the CPI revisions that are going to come in at 8:30, and they are hedging because they're nervous about it. This isn't my opinion. I'm not guessing or assuming that they're hedging. They're hedging. Now, there's three ways that this can go. One of the ways that this can go is that the data is viewed as positive to the market, and we will challenge the ADR half and the ADR full. The market will get this data and deem it negative, and will challenge the lower ADR half and the lower ADR full. Or the market will get the data and it will be so muddy that they have to call timeout and send the data to the nerds, and then the nerds will send back an answer at some point today, and the market will start to respond at that point. And if it's that, we're going to just chop about a bit. So, you know, as usual, we can hold the line, rally, or drop. Thanks, Captain Obvious. That didn't really help, right? But if it's a big move, like this CPI candle or the non-farm payrolls candle, if it's one of those, then we get the gap close play. So a big dump down sets us up for a rally up to get the gap closed. A big spike up sets us up for a fall back down to get the gap closed. It's exactly what happened last week, right? When we dumped down Friday morning for non-farm payrolls, and then we rallied back up, got the gap closed, and we kept right on going. That would be this day here. First, we got the gap closed, and then we kept right on going for the day. Really extended ourselves beyond that VWAP. Notice the difference, though, between Friday last week and Friday today. We're driving up right now. The volume is really light. We just spoke about that. And when volume is light, price can really move, because it doesn't take much for price to move when there's not a lot of people participating. This usually throws newer traders off who believe that you got to have volume to move price. I mean, intuitively, that seems to make sense. But if you ever traded on the dome, then you understand that the lack of orders on that dome is why we can move so far. So here's the dome, the depth of market or active trader on Thinkorswim. And the ES generally has hundreds of contracts per tick. If it's light trading and we're in double digits instead of triple digits, then one big order of 100 could take out that 22 plus that 46 and would bring us all the way up. It would move us 2 ticks in one spot, just that quick, because a big order of 100 came in. This is my jigsaw. At 7:22 this morning, a 100 lot order came in, and it was able to move the market. These other orders are all greater than 50. These orders are all greater than 25, and these are just greater than 1. So because of the lower volume, it doesn't take as much to move price. And right now, we're driving higher through that call wall. What does it mean that we're above it? It's supposed to be a spot where they monetize the calls. We expect them to sell calls there. Think about it. If you had bought calls for the 5,020 strike and price is finally there, what are you going to do with it? Especially if you're holding $10 million worth of them. You're going to just be greedy and hold on for more? No, you're probably going to start monetizing those and closing them. And so we see that as a negative pressure. We expect selling at that level. So if we get through it, it means they're going to start they're going to start pressing those longs harder. It also could very likely mean that we're going to see that call wall roll up. Next week is OPEX, options expiration. So we expect that was going to be when we lose that call wall, because it's going to cost them time and effort to move that wall. Why move it if they don't need to? But now we're seeing that they may have decided to go ahead and move it. That's where the call wall was last night going into the close, which is why the data put that line there. But since then, they could have already started to roll that wall out. And for all we know, it's being dissipated or tore apart as we speak. And by Monday, when we come in, we may find a brand new wall rolled up into, say, 50-35 or 50-50. We just don't know yet. Also, we're not in the RTH, and a lot of places don't trade before that RTH. So we have to give it time to see. But the call wall is only part of this entire issue today. The CPI revisions is a bigger threat or a bigger deal. We're very likely going to get a big bar like we did last Friday. And then the question is going to be, are we going to get the gap close from that big bar or not? There's plenty of examples where we get a big bar on non-farm payrolls, CPI, and instead of closing the gap, it just continues to go in the same direction that the big bar moved. So say we pop to the upside 30 points, well, 10 points, and we get into 50-37. And then instead of falling back down to close the gap, we just keep right on going. And we get into 50-60, which is the full ADR. It's entirely possible that we could go in the other direction too, that we get a big bar to the downside, which brings us into, say, the daily pivot points. And then instead of trying to close the gap, we just continue to go lower. The voodoo lines are not going to be helpful this morning. In fact, no pivot point is going to be helpful this morning until after the big move comes, right? Whatever the data we get that initially moves price, that's all fear and greed and the algos. So we'll get that initial burst up or down, and then the levels will start to matter. And I didn't mention it yet, but as usual, when we get a big data print like this, we could get a big candle that moves us in both directions, up and down, and we close near the same place that we opened on that candle. I showed pictures of that. That invalidates the gap close setup, and it also shows that market indecision. To me, when I see one of those prints after CPI or non-farm payrolls, it tells me the data was muddy enough that they called timeout and sent it to the nerds. I know it sounds funny, but a lot of fund managers only know how to do a few things. It's not like they're, well-rounded in everything that they do. And if they don't get the answer that makes sense to them, they won't just decide to trade anyways. They'll call timeout and send it to the nerds, have them crunch the data. Once we get past this CPI revision this morning, the only thing left is a Fed speaker. And I don't know if the Fed speaker is adept enough to speak on the numbers we're going to get today. But keep in mind that if there's Q&A, that we could see an exaggeration of the move once the Fed speaker starts speaking, because if they're going to do Q&A, they're very likely going to ask her what she thinks of the move and what she thinks of the data and how it might affect her decision for, a rate cut, which makes her speech today even more important than it normally would. We have an MDP this morning. It's a missed daily pivot. We haven't hit it yet. we didn't hit yesterday's either. Yesterday's counts for today, or I should say that's Wednesday. There's Thursday. And now Friday. So Fridays doesn't count yet because Friday isn't done, but Wednesday and Thursday counts because those days are done and we did not hit the pivot point. Again, I don't trade that strategy. It's not mine. If you Google it, you'll find it. It's called missed daily pivots. It really is worth learning just from a technical analysis perspective. If for nothing else, it's at least good for that. But we're getting a little out there on this metric, even if it's not showing up on market breadth tools. So for anybody who doesn't have Thinkorswim, you won't have a market maker move, but you can look for it. Just look at the front end. And of course, we're talking about the ES, but you can do this on equities too. Usually on equities, you see it for earnings. On Thinkorswim, it'll be right up here. You don't even need a label for it. But if the front options have a higher average implied volatility than the next series out, then you have a market maker move. Every article and every piece of data that I looked at for market maker move was always talking about earnings, and they didn't even approach the idea that you could use it on futures. And to me, that was just mind boggling, but use what we got, right? 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. This is a chewed up piece of bubble gum. There's just nothing here. It's a complete mess. Now, the blue profile here shows us that we've spent more time across this top combined than we have anywhere else on the chart. It's very close for this volume profiles point of control to come up to us. If we come back down into that 50-11 cog line one more time, it's almost assured that we're going to get the point of control up there. The funny thing is, even if we don't go back down to that 50-11, the point of control is going to go up there anyways. Because as the day goes by, we're going to lose these candles here on the left. We're going to print new candles on the right, and that will make 50-14 the new point of control. So when you're looking at this thinking, wow, we're a long ways from that point of control, if that's my support, it's really far away. It won't be. It's going to be right up there with us, and that means we can fall through it or break through it really easy because we don't have to go to it. It's coming to us. It's really something to consider as the morning wears on. So I would come back to the 10-day, 30-minute volume profile probably around lunch, see if it's happened yet. You can be preemptive and just go ahead and put it in your notes that that's where it's going to be, and don't even bother waiting for it to move there, because at this point, it may as well be there. We have a new VPOC from yesterday. The cog line again, 50-11. So VPOC, Virgin Point of Control, it hasn't been hit, so it gets marked. I don't think we have any overhead to deal with. They're all underneath us. Yeah. And spread out pretty wide too in the grand scheme of things. We are 4% above the 10-week. When we look back, other than COVID, and we just park our mouse there at that 4%, you can see even in the last year that there were 3 other times we got higher than this. We got above 5% actually. And in 2022, there was a couple of incidents where we got that high as well. Nearly every month we were getting one back there. That was a really bullish time. 2021, 2020, we were coming up out of that COVID and we're just getting those really big expansive moves. But once we got out of that, we really weren't seeing that kind of continuous drive, right? These are really spread out. So we can go farther than this, but we're in the upper edge of what we would consider, you know, decent. Have we gone too far, too fast? Yes. We're due a pullback. Just to be clear, markets can continue to run long after they should have fallen. So a blow off top, for an example, is a capitulation play. It's just in the other direction. It's the last hurrah before the dump, and it can really pop. We have our weekly expected move. $50.32 cog line. Everything's lining up on that 50.32 and 50.11 today. We close inside this box 80% of the time on the S&P, 70% of the time on everything else. But there's times where we don't just break out of the box once in a while. And it's not even breaking out the counts. It's closing on Friday out of the box. If we do it once in a while, it's fine. The concern is when we start doing it repeatedly over and over and over again. Last week, we closed outside the box. Just barely, but barely counts. Hand grenades and horseshoes. So 1 week doesn't matter. Repeated weeks over and over and over, that's a warning. You can look at the market before COVID and look at how many weeks in a row we were breaking out and closing outside before the big fall in February of 2000. Skew was off the charts and we were breaking out on the week and closing outside. Those were warnings, even if we didn't know what the warning was. One thing that we can do is, even though the new week is showing, it's not set in stone yet. It's not locked until 4:15 tonight, but we can get a gauge. We can get a feel for how things are going. We can take our current week and we can just set it up there. Notice I didn't zoom in and get it to the tick and try to make it exact and perfect. You don't need to go to such lengths. Just kind of eyeball it. Does that look bigger or smaller than the current week? It looks smaller. My box is sticking out on each end. These ranges are derived from volatility. If the volatility is less, the range would be smaller. My box would stick out on each side. If the volatility was greater, the range would be bigger and my box would be smaller inside this range. So we can look at this and say the volatility is being reduced. There is less volatility next week. Yay for us. It's not set in stone, though. We'll want to check again on Monday to see if that still holds true. And this cyan line down here is the year-to-date VWAP anchor. I mentioned when we got back above it back here that we were probably done messing with it for a while. That still holds true. I don't think we're going to come back and mess with that for a while. March, maybe around that FOMC. And if not then, maybe May with the next QRA. But we are extended. We are ready to pause. And remember, when we classify that the market is overbought, it is extended, that one of the ways it can correct itself is through time. I always thought that was a phrase. I didn't realize it was actually a thing. You can correct in time, or you can correct in price. Correcting in price is just a pullback. Correcting in time is just staying sideways there, waiting for the 10 to catch up. So what that means is we don't have to fall. Here's the 10-day. We're only 1% above the 10-day. That's nothing. So in the short term, for today, for an example, we could easily run 2% today, no problem. When I look at these and try to think of an analogy that goes with this, how far away from the moving averages we are. It's not like a wall or a ceiling, because that would imply that we can't get past it. And we know that that's not true. We certainly can. The analogy that fits is, think of a runner running upstairs. And in this scenario, the farther away from the 10 you get, the more weight you add to the backpack they're carrying. So when we're 1% away, maybe the backpack's not too heavy. When we're 2 and 3 and 4% away, think of a backpack with 200, 300, 400 pounds on them. Can he still climb the stairs? Sure. It's just going to be a lot harder for him to do that. And it's probably going to take a lot more time. So we can rally at 3% above the 10-week, 4% above the 10-week. We can still go up. It's just going to be a lot harder for the market to do that. The moves will be slower. They won't move as far. They're very likely to retract quicker. All of those things would be true. I showed this chart quite a bit when we were doing the QRA. And from the consensus of the fund managers that I was keeping track of, and even when I straight up asked them, what do you think this QRA now is going to give us? What quarter does it line up with? Something like this first quarter back here. So first quarter, second quarter, third quarter. What do you think we're going to get? And their answer was, well, we still need to see the 10-year, the auction there, and the 30-year, the auction there. But from the data that we had at the time of the QRA, their consensus was that it was going to be a pullback like first quarter. We would likely pull back into the March FOMC. They would come out chipping teeth and kind of pick us back up again, and we'd be back to almost the same level for the next QRA. And that would be a wrap. Okay. I mean, I am willing to entertain the notion, but this was Q1. We had that QRA and it popped up, and then it just continued to grind lower. And this is us now, where we've popped up and we've continued to grind higher. So it doesn't really match. Let's get through OPEX. That's next Friday. If by the Monday after OPEX, this hasn't started to demonstrate Q1 kind of price action, then we're going to start looking at maybe third quarter, which was really aggressive. I just don't see that it's that. Maybe second quarter, right? Where it kind of lollygagged a little bit, but then it started working better. I don't know. Maybe we don't have enough examples in those 4, and we have to take it back even farther. Really no reason to go through the equities on what's up this morning, because it's all going to be dependent on the data we get. Anything that's up now can be down and vice versa. Bitcoin is up significantly, so you should see their proxies. Riot, Mara, Hut, Hive, Coin, MSTR, all of those should be doing well this morning in some form. Yeah, I'd say it's doing well in some form. It's a nice continuation from yesterday's big move. We're at 14.25 this morning, so we're looking at Riot all the way up here halfway into this big candle. We'll just take that and move it over. 1493 likely where Riot hits its head. Same thing with Mara. They're all on the move, and it's a continuation, right? We can see Mara started Wednesday into Thursday and now into Friday. Talk about something that looks like a blow off top. Mara's nearly at $24, and so that would put us into this upper zone. We'll just use this. Focus on that bar. Well, that didn't do us any good. 24. Yeah, it did. It's overhead right there. So we do have Bitcoin proxies on the run. Not surprising that FANG up. So FNG. The FNG is the FANG group, and then you add the D for down or the U for up. The FANG up is up this morning, as opposed to the FANG down, which is probably down this morning. These are new to me. I'm not not really comfortable with them yet, but I'm growing into them. One of the things that I've been doing with them is I turned it into a ratio chart and looking for divergence, of course. We had some divergence back in August. We had the October turn, and that was with everything. So I don't know what I'm going to do with this yet, but it's something that I've been keeping track of, especially with the divergence, but also individually on a bullish day. You know what we had last Friday in the pre-market? We had FNGU with a lot of volume. It's where it really got my attention last Friday. So now I'm keeping my eye on it a bit more. Look at how it was Thursday first into the close, and then really a lot of bullish activity in the pre-market. And of course, that got my attention. It's the FANGs, right? So you can go to MAGs. That would be like the Magnificent Seven. Spot Gamma uses this. In fact, they talked about it in their founder's note Wednesday night. We can just use the NY FANG, but this doesn't have pre-market activity. We can use our own little homemade ETF, the one where we, use our own weights, something like that, which would be giving us a red to green because it was red yesterday and now we're green this morning so far, gapped up. But whether or not these hold will be dependent on the data that we get. there's been some confusion over these levels that I share on a day-to-day basis. So since digging through any of the equities isn't really going to do too much of a service to us today, we may as well try to clear up some of this confusion over the data that I share every day, because I'm not going to go through too much effort to share it if it's not really helping anybody out, right? So let me make sure that person is here. I appreciate that. The thing that is getting people hung up are these things here, where I post these HTTP links every day. There's options levels that you have to import and spot gamma levels that you can import for Thinkorswim, but you have to do them every day. And someone's confused about this. But they're not responding to me, so not gonna run through it. Unless anybody here is still not understanding how to do it, then we'll go through it. Aha, you're here. All right, Anthony. This stuff that I share is updated every day. It's not going to allow you to look at any equity you want and see levels. Okay, that's not how it works. I have a watch list. I get the levels for the things that are in my watch list, and I share it. My watch list is in this dashboard. It's the things that I want to trade that I know have good options and or that I watch to see how it'll affect the markets. Like I look at sectors, I look at the indexes, even if I'm not going to trade those sectors. If you want individual equity levels that aren't in this list, you can ask and I can probably get them and then send them your way. I don't know that they'll work with the code that I sent, but I have my own list of stock, which is in the watch list that I shared. And from that, every single day, I give the levels for it. I also give the spot gamma levels, which you can use on the ES and the NASDAQ futures, as well as SPY, SPX, QQQ, IWM. Spot gamma is the only one that I know that provides the levels for the futures. Other places will give you the SPX levels and then say, well, you can overlay them on the ES. That's not the same thing. You know, that's not what we want. We want levels for the futures made by the futures. So when I share those levels, they go to my watch list, the names on my watch list that I got the levels for. and I don't change the names very much. So it's these names. They're easily recognizable. The indexes are in there, obviously, the Qs and SPY, but also the XLs. So the XLY, the XLE, and then there's the China ADRs and the FANG names. One of the reasons that I pick this list is because if you're going to look at options stuff and you're looking at junk, no-name trash companies, they're not going to have good enough options data to provide good levels. As for any of the charts that you see me use, specifically every morning when I come in and I do this, that chart and this chart, this one, and this one, I share every one of those charts with the link in the YouTube description, along with the Thinkorswim workbook link. And if it's not in there, because at one point I took the workbook out, just ask me for it and I will send you the link so that you can go to the Discord where all of my links are at. Anything that I can share on Thinkorswim is in this Thinkorswim workbook. Every watch list, chart, indicator, label, strategy, everything I got that I can put into the public is in this Discord. But specifically, what I show every day, the charts that I use every day, they're in the description on the YouTube video. So if I just copy everything in the YouTube description, post it in the chat, that will maybe solve the problem. There you go. You don't even have to do that. It's right there in the chat now. If you do want the video, there you go. That's what I got for you guys. Watch the clock. 3 minutes. We're going to get the data, and then we'll play the levels from there. Have a good weekend. What's my view of the market today? I don't know if you showed up late, but you can catch the replay on YouTube. It's all dependent on